Warren Buffett's investment strategy. Number 1, company performance. Return on equity is sometimes referred to as the stockholders' return on investment. It reveals the rate at which shareholders earn income on the shares. Buffett always looks at return on equity to see whether a company has consistently performed well when compared to other companies in the same industry. Return on equity is calculated as below. Return on equity equal to net income divided by shareholders' equity into 100. Number 2, company debt. The debt to equity ratio is another characteristic Buffett considered carefully. If he was to see a small amount of debt with earnings growth being generated from shareholders' equity rather than borrowed money. Debt to equity ratio equal to total liabilities divided by shareholders' equity. Number 3, profit margins. The company's profitability depends not only on having a good profit margin but also on consistently increasing it. This margin is calculated by dividing net income by net sales. Investors should look back at least 5 years for a good indication of historical profit margins. A high profit margin indicates that the company is executing its business well. Number 4, company is public or private. Buffett typically considers only companies that have been around for at least 10 years. Most of the technology companies that have the initial public offerings IPOs in the last decade would not have appeared on his radar as a result. He said that he does not understand the mechanics behind many technology companies and only invest in businesses that he fully comprehends. One important point to remember about public companies is that the Securities and Exchange Commission requires that they file regular financial statements. The documents can help investors analyze important company data, including current and past performance, so they can have important investment decisions. Number 5, commodity reliance. You might initially think that this question is a radical approach to narrowing down a company, but Buffett sees it as an important one. He tends to shy away from companies whose products are indistinguishable from those of their competitors, as well as those that rely solely on a commodity such as oil or gas. Buffett sees little that sets a company apart if it does not offer anything different from another firm in the same industry. It is cheap value. An investor must determine a company's intrinsic value by analyzing several business fundamentals, including earnings, revenues, and assets. A company's intrinsic value is usually higher and more complicated than its liquidation value. When Buffett determines the intrinsic value of the company as a whole, he then compares to its current market capitalization, its current total worth or price.